Thank you for joining our Economic and Market Update webinar today. My name is Jessica Ballin. I'm one of the advisors on the 401k Plan Professionals team. If you're not familiar with our team, we serve plan sponsors with their retirement plan needs and also the participants inside those companies. Today's webinar is part of our regular webinar series. Most of our webinars are around 30 minutes, including today's webinar. We will have time at the end for questions, so please use that chat feature and we'll get to those at the end of this webinar. All of our webinars are recorded, so you will get a link to today's webinar following today's meeting or today's webinar. And we'll also, we have them all out on our YouTube channel, which is 401k Plan Professionals. You could follow us. And also out on our website, all of our past webinars are out there. We're actually hosting over 18 webinars this year. So we're really excited for Marta Rodriguez today. She's hosting a quarterly economic update webinar for us. She's a repeat speaker and provides a lot of knowledge from JPMorgan Asset Management. She's a defined contribution client advisor. She really is a very valuable resource to us. We utilize a lot of JP Morgan's tools and resources and rely on Marta for a lot of our economic updates. And last time we hosted this in April, it was more of the start of the Iran war. Inflation was going up and oil prices were going up. And so we had a lot to discuss then. So we're excited to have Marta back to see what JP Morgan's saying about the markets. So go ahead, Marta.
Thank you so much, Jess. And it's a pleasure always doing these with you. And kudos to all those who are on this morning as well. To take some time to invest in learning a little bit about what's going on in the economy and the markets and what that means for us as long-term investors. And as just alluded, there's been a lot of things going on this first half of the year. It's definitely been action-packed. But then yet again, I think I say this action-packed all the time. But there's been a lot of headline news, some financial headline news, some not. Some things that, for instance, we're celebrating 250th anniversary of America, right? We also were a host country for the FIFA World Cup. A lot of great stuff there. Data centers have been in the news a lot, right? Just the building of them, some conflict around debate around power and resource demands. There's been a shift in Fed Reserve policy because there's a new Federal Reserve chairman in place, Kevin Warsh. There's some upcoming midterm elections coming up, cost of living increases. We're definitely feeling that. And there's this little thing called this skirmish with Iran that's definitely interrupted things and affected the Strait of Hormuz and the flow of oil there. So amongst all this, right, this does affect and create volatility in the markets. But it's important to ground ourselves really in the fundamentals of what's most important when we think of what's important to us as long-term investors. One thing just to highlight real quick, I think that one of the headlines that's really dominated, though, the market space is the boom and just the AI infrastructure build out. It's a massive $670 billion AI infrastructure spending that is happening by these hyperscalers, right? And there is some fear that perhaps AI is advancing too quickly for thoughtful regulation. Others also worry, hey, do the end user revenues, are they lagging too far behind a lot of this spending that is happening by these companies or not? Right. But beyond that, AI, though, is generating huge profit gains. It's adding to investment spending by companies. We're seeing that boost upper income consumer spending via this wealth effect. If you checked us as long-term investors being invested in our 401k plans that are in the stock market, we've been beneficiaries of this, right? So we've seen our market values go up, and it has coincided with some very solid gains in productivity. However, right, under the hood, there is some weaknesses that we just want to be aware of. I'm going to go over some of that this morning. Job growth has definitely been a little bit stagnant. It's barely positive this year. That also net migration has definitely put a damper on labor force. We'll go over that. We've seen inflation skyrocket up, starting to peter down a little bit. But employment is definitely getting softer. So the bigger question is, hey, what's going to win at the end of the day? AI, the boom span there. But again, or will it start to be dragged down a little bit by some of these weaknesses that we see under the hood? So what we're going to do is just touch upon a few of these economic variables, wrap up with just some thoughts on where the Fed is thinking, the Fed policy, and what does all this mean for us as long-term investors? So just to kick things off, I've started the last couple of quarters with this slide on the oil and the economy because I think this is relevant to our everyday life. I mean, literally yesterday I gassed up my tank and it was still pretty pricey. Granted, prices have come down somewhat, but the conflict in Iran definitely has pushed the oil prices higher, though we do expect that surge to fade as tensions do ease and as there is somewhat of hopeful peace talks that will be transitioning and continuing to happen. But on the left-hand side of this slide, in the orange, which indicates the year 2026, you'll see that the prices have been going up. It's currently hovering at a national average there around, $4.10 per gallon. But unlike past oil shocks of years past, we as a country, the US, are a net exporter of oil, as you can see in the upper right-hand chart there. You'll see the gray chart going back to the 60s and 70s, spiking up above zero. That's because back then we were importing a lot of that oil that we needed. However, really, since the 2021 timeframe, you'll see that numbers dip below zero, meaning we're exporting more than we're importing. So who are the beneficiaries of these oil prices going up? A lot of the energy companies. And if you'll see, for instance, the S&P 500 year to date, 14% returns. The two biggest component sectors are energy and technology. Double-digit returns there. So whereas it hurts us from a consumer perspective, it is helpful for the energy companies, which translate again to, if we're invested in the markets, is helping our long-term portfolio returns. But again, I don't want to just dismiss the fact that if you look at the bottom right, it is impacting, especially the higher prices, the bottom 20% of these household incomes out there, where gas prices, energy prices does take up a bigger percentage of their overall economic budget. But again, it is helping long-term returns of companies, and we're going to see what is the long-term economic growth that we're looking at here. What makes up economic growth? The upper right-hand box is two things basically. It's the growth in workers, the sheer number of people out there every day working, and then how productive are they? So the growth in the real output per worker, how efficient are they? All right. And as you will see on the upper left-hand side, the growth in the working age population, it has been going down. Again, a lot of older people, the baby boomers are exiting the working age population. They're retiring. So kudos to them for being able to retire. A lot of the new people, though, that are entering the working age population is less, right? A lot of young folks are having less kids now. And you'll see that in 2020 to 2025, the growth in the working age population was around 0.5%. So definitely less than in decades past. But a lot of that growth came from the immigrant population. You take a look at the census forecasting out, you actually see a negative 0.3% growth, of which a lot of that is due to the fact that net migration has been going down. On the positive side, though, on the bottom left, you'll see that companies are spending more on research and development and on equipment, intellectual property. This has increased the productivity. So even though there's less workers, we're a lot more productive, and this AI boom will help create more efficiencies, and that productivity will continue. So the very far right drivers of GDP growth, you'll see we're estimated to be around 2.3% gross domestic product for the years 20 through 2026. a big portion of that is ingrained, meaning a big portion of that is coming from productivity. So continuing with what helps us grow, we're going to look at some of the components of GDP growth. Now, traditionally, we always a healthy, developed economy, we like to be at 2% or higher growth. Last year, the numbers were actually, pretty good. You'll see the second half of 2025 and third quarter of 25 that we had 3.8% and 4.4% real GDP growth, which is really strong. A lot of that having to do with some of the net exports that we were seeing, as well as a lot of government spending and just consumer spending. It has since flipped. If you take a look at far, far, far right, the biggest boost to what's driving GDP growth is blue. So us as consumers, we are continuing to spend. We also did receive, if you look at the second column to the right, in green government spending, we did get a lot of, when you filed your taxes earlier in the year, there were a lot more people who received income rebate checks coming back to them. So that definitely helped us be able to spend more, even though inflation was higher back then, which put a little bit of damper on that. Looking ahead, though, we do think that we're going to have steady overall economic growth, but it will be somewhat restrained as just due to some of the factors we're going to be talking about, job growth and government and spending. But we do believe that a lot of this AI-driven capital spending will continue to boost the GDP growth. So turning real quick to labor, I think we just got a report this week showing that total non-farm payroll employment did fall by 23,000, right? And on the far left, you'll see the payroll gains are in blue, and it goes back for the last 5 years, and it's kind of going down, right? So payroll gains have been decreasing somewhat. Again, part of that is just due to the tight labor market that we have. But again, the positive thing is that the productivity has ramped up for the number of workers out there. So that is why we are able to continue with that strong GDP growth. But it is, somewhat concerning, right? That payroll has gone down. And similarly, on the far right, you see both wage growth and the unemployment rate. The unemployment rate historically, the 30-year average was at 5.5%. That actually has come down. As of the end of June, it says 3.4, it says 4.2%. It's actually just this week, as of the end of July, 4.1%. So we have been able to, our unemployment rate has gotten lower just because, again, there's not as many people that are working. But the wage growth itself has also come down, right? Normally, when unemployment rate goes down, wage growth goes up. And when wage growth goes down, unemployment rate goes up. However, you'll see that at the very end, those two lines kind of go down together. That's because a lot of companies are there's a smaller pool of just available workers, right? And they're just demanding, say, hey, we can do more with less workers, and there's less unions out there. So a lot of companies are just capping the wage growth there. And a lot of workers don't feel strong enough to be asking for raises. When was the last time you all asked your boss for a raise, right? So a lot of people are nervous about asking for raises in this type of environment as well. So because of that, because wage growth has been coming down, that has bled into the inflation numbers, right? Because if wage growth is going up, that puts upward pressure on inflation. But inflation has been coming down, which is a good thing, right? This chart's got a lot of colors. But I think the main point here to illustrate is, I don't know if you all remember, but only 4 years ago, inflation was crazy high, right? You'll see there in June of 2022, inflation peaked there at 9.1%. That definitely hurt us, right? But since then, a lot of that inflation has been going down, right? But you will notice though, since the start of January, so the far right, the green colors have been going up. Green is the energy prices, right? So again, because of the conflict in Iran, the Middle East remains, the tensions there remain, we have seen those inflation numbers spike up on the energy companies. But we do expect those to somewhat decrease as the tensions start to ease. We currently are sitting there at around 3.5%. And actually, just this week, just actually yesterday, the July CPI report, which is a measure of inflation, said actually went down to 3.4%. So we're slowly going down. Interestingly enough, some of the categories where we've seen increases and decreases. Food at home prices actually slightly decreased, while food away, so in restaurants, have increased. So I encourage you all to cook more at home. It's a little bit cheaper. Um, except for funny enough, lettuce. Lettuce prices fell 16.4% as consumers try to, not be try to avoid getting sick. That cyclospora outbreak that we've all been reading about in the news, it has impacted lettuce prices. So if you want lettuce prices, they're really cheap now. Other categories that have increased though, medical care, airline fares. If you try to book a flight recently, those prices are a lot more expensive. Communication, education, all that stuff has gone up. But we do believe, though, that the Federal Reserve, they have a 2% target that they say is good for a well-running, healthy economy. We're above that currently at 3.4, but it has been coming down, and we believe that it will continue to come down. And because of that, the Federal Reserve, they haven't yet taken any action. The last time they met, they did not raise or lower rates. And hopefully, we'll see what happens in September when they meet again, whether they'll be patient enough to allow inflation to slowly fall back to its target on its own. Speaking of the Fed, it's been a swing in just expectations of what they were expected to do with rates from the beginning of the year to where we are now. Coming into 2026, the market expected there to be actual rates, the Federal Reserve raising rates on the short term end. And but since then, you've seen again inflation tick up a little bit, which has created there to be a pause, right? So the Federal Reserve currently their effective Fed funds rate is sitting at 3.63%. On the far right, on the gray, you'll see that number. Now in green, that's the market expectations. You'll see that the market is assuming, is pricing in that the Federal Reserve is going to raise hikes. However, the Fed themselves in blue, that's their projections of what their estimates are. They're saying, hey, no, we're not going to be, raising rates. And we ourselves do believe that um, we probably will be sitting on hold for this year, possibility of maybe rate hikes maybe starting next year. But as of right now, we do believe that the Fed will keep things as is, which is good for us as investors, especially when looking at the fixed income world. So I'm going to switch real quick to what does this mean for us as an investors? Fixed income. I often get asked the question, hey, why do I want to invest in fixed income? Especially when I look at the stock market. And for the last 3 years, I've had like 20% plus returns in the stock market, right? Fixed income, ho hum, a little bit more boring. However, fixed income does serve a purpose in a diversified portfolio, and it does serve as that ballast for providing us that lower correlation. So when stocks zig, bonds will zag, and that helps create that overall much more not as volatile ride for us as long-term investors. And what's interesting right now is that income, so what these fixed income bonds, the yield on these things are pretty healthy. I don't know if you all remember but even early 2020s. So we're talking, so in this chart here, the very, very far left corner there, that dark green color, in the early 2020s, there was like a 0% yield, even negative yields that the fixed income bonds were producing, right? So any shock in interest rates had a very big impact on the total returns of our fixed income portfolios. Because there's a rule of thumb with fixed income, when rates go up, when like the Federal Reserve rates, go up, bond prices go down. So there's this fear, hey, if the Federal Reserve starts hiking rates, our bond prices may go down. As I just mentioned, we don't believe that rates will rise that much going forward for the near term. But even if they do, right now, the current yield for the Barclays aggregate bond index is around 5%. You actually are getting paid now. Income is there. So even if there is a slight dip in bond prices, the overall total return of bonds is relatively healthy, which is why we are still big proponents of being invested in fixed income alongside the stock market in a diversified portfolio. Now I'm going to have to skip to just running a little bit short on time here. But let's go to the stock market real quick. I think this is very interesting. And again, especially when looking at the fact that the last 3 years, the S&P 500 has had tremendous returns. 2023, you had 26% return. In 2024, 25% S&P 500 returns. 2025, almost 18%. Even year to date right now is at around 14%. So these huge numbers, right? That has come though with just some concern around, hey, how long will these double-digit returns last? A lot of that is beneficiaries of this AI boom that we've been talking about. But then also, has this made the stock market too expensive, right? And one way we measure if the stock market is expensive is something called the PE ratio. That's the price to earnings ratio. How much are we willing to pay for a stock price based off of how much earnings that company has to support that, right? So with the big meteoric rise that we've seen in the stock market, we would think that the PE ratio would be super, super high. So things would be super expensive. However, as you'll notice, and the box in the middle there, the average PE ratio for the 30 years is around 17.2 times. So price to earnings. Currently, we're at 19.3. So yes, it is a little bit expensive, but not so much as it used to be. And again, the earnings of these companies that we reading, and a lot of these companies are beating their second quarter earnings, are supporting the prices that we're paying, right? But again, people are somewhat concerned. And what does that concentration, those some of those top seven names look like? That's something that this is the last chart here on the stocks I'll share real quick. That the Mag 7, this was a something that we've talked about in the past, that concentration in those top seven stocks in the S&P 500. The ones that you're probably all familiar with, Nvidia, Meta, Tesla, Amazon, Alphabet, Microsoft, Apple. In the upper left, you'll see the performance of the S&P 500 and the performance of those top seven companies. In 23, 24, and year 25, those seven names did account for a large portion of the overall return. So in 2023, for instance, the Mag 7, they made up around 63% of the overall total S&P 500 return came from just those seven stocks. But that has since shifted. 2026, year to date, the other 493 names have solid earnings. They actually are earning more than those top seven names. And in actuality, if you take a look at the far right-hand side, year to date, there's a number of those Mag 7 names that are actually negative so far this year to date. So the important thing here to think about really is the fact that as long-term investors, we want to position ourselves, yes, to have exposure to some of these names, but also to as a bet on the future, but not as a reflection of past performance, right? We want to work with active managers that can really take a look at, hey, beyond the ones that are driving performance today, who are the winners of tomorrow going to be, and do I have correct exposure to those winners as well? And speaking of the winners of tomorrow, this chart is super, I think, interesting. And what this shows literally is just, hey, here are the 10 largest companies in the S&P 500 over the last 4 years. If you'll notice, everyone remember back in the 80s when like DuPont, Kodak were names that we saw at the top? None of those people are there today. The only one that has lasted really the last 20 some years has been Microsoft, but everybody else on the far right has been new as of the last few years in the top 10. Again, the winners of today's winners may not be the ones that are there tomorrow, which is why it's important to have active management in order to capture the winners of the future. And I would be remiss not to mention global equity, right? Again, being diversified is super important, being invested not only in the US, but outside the US. Does anybody remember? So the far left column, we show the returns for 14 years, from 2010 to 2024. The US dominated performance returns versus Japan, Eurozone, emerging markets, anywhere outside the US. That flipped last year, 2025. You saw these much larger returns happening outside the US. And still today, the far right column, you'll see that emerging markets, 12.8% return versus the US, 9.4% returns. And it's not just because of currency reasons, but the blue, dark blue, shows a lot of that is because of the earnings that these companies outside the US are producing. That, along with the fact that a lot of us tend to be under diversified to international, and these things are still on sale as from a valuation perspective, is really, is a good reason why we should think about and re-diversifying and making sure we have enough exposure to companies outside the US as well. And that is the last chart I'll share with you today, is just that diversification chart. Again, diversification here in the US, diversification outside the US, in bonds and fixed income. Over time, I'll show you the first two columns on this chart shows you in the past 15 years. At a properly diversified asset allocation will produce a 7.5% return with less volatility than some of the other individual asset classes. So for us as long-term investors, the ride to retirement is a lot smoother when we're properly diversified. So with that, I'm going to turn it over to Jess to finish us up, and with a few minutes to go.
Amazing. Thank you. Yeah, it's so true. When you're looking at the average 401k investor, and they're diversified in those, model portfolios, target date funds, they've done phenomenally well because of that allocation to small cap value, and international. And in the last 18 months, those categories have performed better than that Mag 7. So it's never been a better time to make sure you're diversified, right? So just to kind of close it up, as I mentioned earlier, this will be recorded. You will get a recording link sent to you following today's webinar. You'll also find it out on our YouTube channel and on our website. And you can also find all of our previous webinars out there as well. We record all of them. And upcoming, kind of looking to the future, we have a couple webinars still this year. We have one of our more popular webinars, which is Medicare. And that one is in September. And then also we're doing a 3-part series on generational investing, and our last one is on millennials, and that will be November 19th. But you can go back and listen to the previous ones if you're more of a baby boomer. And then just kind of closing up with any sort of, we also host a lot of one-on-one meetings. So you can find that out on our website as well, and all of our resources. Or of course, you can always just email me if you have more kind of individual questions. Just kind of one question that came up was just kind of on the rates and your thoughts on, I think you had maybe mentioned something on possible rate hike still possible this year, where I think if you were to go back and look at December of 2025, we all thought rates were going to come down a couple times this year. And so Is that what JP we're hearing from your
Yeah,
experts?
so in the market still, as you saw, the market is pricing in rates going up. However, the Fed has definitely put a pause on things, right? You have new Fed chairman in place there, reevaluating, looking at everything. And just again, we mentioned and you saw the inflation charts, things are starting to cool down. The latest print, just literally this week, does show that it is somewhat coming down. So we don't believe we that anything will necessarily perhaps happen this year. But maybe for next year in 2027, we might see something, there that will be happening. But as of right now for this year, we do agree with the Federal Reserve projections where they will probably be on hold for the rest of this year. But it'll be interesting to see what they say in September. But yeah, that is our
Yeah,
projection for this year. Nothing, but possibly for next year.
yeah, yeah. Okay. Amazing. Well, thanks everyone for joining us. Thank you, Marta, for another exceptional economic update. You always cover the material so well and easy to understand. So thank you for your
Great.
insights. Thanks,
Thank you so
everyone.
much.